What if silver is no longer just a precious metal story? What if it is becoming a strategic resource story? That is the question investors need to ask right now. Because the forces moving silver are changing
The
fast.
current spot price
Trade
trend
policy
is
is
concerning.
changing.
The charts
Industrial
show a clear
demand is
resistance
changing.
level
Supply
forming.
chains are changing.
However, this
And
specific
Washington is
mintage
paying
is an
much more
exception.
attention to critical minerals than it did only a few years ago. President Trump has already directed negotiations around processed critical minerals. That move could have major implications for metals that sit at the intersection of money, technology, energy, and national security. And this is where the phrase, silver is the new oil, becomes interesting. Oil is not valuable only because people burn it. Oil is valuable because modern economies depend on reliable access to it.
With
Silver
rising
is starting to
inflation
enter a
and
similar
market
conversation.
uncertainty,
It is used
the
in
demand for
electronics.
physical
It is
gold
used in
has
solar
never been
technology.
higher.
It is used in electric vehicles. It is used in advanced manufacturing. It is also a monetary metal. That combination makes silver very different from most commodities. The market is not simply asking how much silver exists. The market is increasingly asking where that silver is located, who controls it, who needs it, and whether enough new supply can arrive when demand rises. The Silver Institute expects the global silver market to remain in structural deficit for a sixth consecutive year in 2026. It estimates a deficit of about 67 million ounces. Welcome back to Silver and Gold Watch. Today, we are looking at a story that could become one of the most important themes in the precious metals market. Trump just turned the spotlight towards strategic minerals.
Gold and
Howard
silver
Marks
are
is
going
known for warning
parabolic.
investors about risk and market
We should have
psychology,
listened to the warnings
and silver
about
is sitting
inflation.
right in the middle of a powerful collision between industrial demand and monetary demand. The important point is that this does not mean silver can only go higher. It means the market
As you can
structure
see,
is
the US
becoming
dollar
more
index
complicated.
is in free
It means
fall.
investors need to understand what is
Gold and
actually
silver
driving the metal
dramatically
before
rising
they
on the
decide
back
what
of this
comes
volatility.
next. The first thing to understand is that silver has always been unusual. Gold has a clear monetary identity. Central banks buy gold as reserves. Investors hold gold as a store of value. Gold tends to respond strongly to real interest rates. The dollar. Inflation expectations, geopolitical stress, and monetary policy. Silver reacts to many of those same forces. But silver also has a second
As the
engine.
markets fluctuate,
That engine
all
is
eyes are
industrial
on the
demand.
precious metals.
This
The
creates a
deadline of
unique
August 19th
situation.
is fast
When the
approaching,
global economy
signaling
is
a
strong,
major
silver
shift.
can benefit from manufacturing demand. When financial conditions become unstable, silver can benefit from investment demand. When investors expect lower real rates,
It just broke
silver can
resistance
attract
again. Look at the
monetary
volume.
flows.
Should
When
we hold or
technology
sell
demand
now?
rises,
I don't like this
silver
volatility.
can benefit again.
Gold is going
It is almost
parabolic.
like
Buy
silver
more.
has two separate economic lives operating inside the same market. That is why calling silver the new oil is not simply a catchy phrase. Oil became a strategic commodity because modern economies could not function without reliable energy supplies. Silver may be moving toward a similar strategic role in selected industries. It is not oil. It does not replace oil. But the strategic logic is similar. A material becomes more important when governments and companies begin worrying about reliable access rather than just the price on a screen. And Washington is already treating critical minerals as a national security issue. In January 2026, President Trump directed the Commerce Department and U.S. Trade Representative to negotiate agreements involving processed critical minerals and derivative products. The proclamation said the administration could take further action if those negotiations failed or proved ineffective. That tells us something important about the direction of policy. The United States wants more control over strategic supply chains. Now think about what happens when a government begins looking at metals through the lens of national security. The market can change in ways that have nothing to do with a normal commodity cycle. Governments may want domestic production. They may want domestic refining. They may want reliable partners.
We are facing
they may want
unprecedented
strategic
volatility in the
inventories.
gold and
They
silver
may want
markets.
recycling
If the
capacity.
current trend holds,
they may want to
we could
reduce
see a major
dependence on
correction by
foreign
August 9th.
processing. That changes the conversation around silver. For years, many investors thought about silver in a simple way. Silver was cheap compared with gold. Silver moved faster than gold. Silver was used in industry. Silver could rally during a precious metals bull market. That was the basic story. The new story is more complicated. Silver supply is not easy to increase quickly. A large share of silver production comes as a byproduct of mining other metals. That means higher silver prices do not automatically create an immediate flood of new silver production. A miner may be producing copper, lead, zinc, or gold. Silver can come out as part of that process. The economics of the mine are therefore influenced by several metals at once. This creates an important supply problem. If silver demand rises rapidly, then new supply may not respond immediately. Recycling can help. Higher prices can encourage recycling. New projects can eventually increase production, but mines take years to develop. Permits take time. Financing takes time. Construction takes time. Processing capacity takes time. That is why a structural deficit matters. The Silver Institute expects total silver supply in 2026 to reach about 1.05 billion ounces. That would be a decade high. Mine production is expected to rise only about 1%. Recycling is expected to rise about 7%. Even with that additional supply, the market is still expected to remain in deficit. Now add investment demand to that equation. The Silver Institute expects physical investment demand to rise about 20% in 2026 to roughly 227 million ounces. That would be the highest level in 3 years. At the same time, industrial fabrication is forecast to decline by about 2%. This is an important detail because it shows that the silver story is not simply about factories buying more metal. Investment demand itself has become a major force. That matters because investment demand can move much faster than mine supply. A factory does not suddenly decide to buy millions of ounces because the price chart looks exciting. Industrial procurement follows contracts, budgets, production plans, inventory needs. Investment demand can move much faster. Investors can suddenly decide they want coins, bars, ETFs, or other forms of exposure. That creates the possibility of a feedback loop. Silver rises, investors notice, more investors buy, physical inventories become tighter, premiums rise, the market becomes more sensitive to supply news, traders begin expecting higher prices, more capital enters, and suddenly, a metal that looked boring for years becomes one of the most watched assets in the market. We have already seen how powerful that dynamic can become. Silver surged above $100 per ounce in January 2026 after a huge rally. Reuters reported that the move was driven by tight physical supply and strong retail investment. The same report noted that silver had gained dramatically during 2025 before the early 2026 surge. But this is also where Howard Marks becomes relevant. Marks has spent decades warning investors about the danger of extrapolating recent performance into the future. His philosophy is not based on blindly predicting the next move. His approach focuses heavily on understanding risk, market cycles, investor psychology, valuation, and the difference between what is possible and what is probable. That is especially important for silver, because the biggest mistake an investor can make during a powerful commodity move is assuming that every new high proves the next high is guaranteed. It does not. Silver can be structurally bullish and still experience violent corrections. Silver can have a supply deficit and still fall sharply. Silver can benefit from industrial demand and still be hurt by a stronger dollar. Silver can benefit from lower rates and still suffer when investors liquidate positions during a broader market panic. That is why the real opportunity is not simply predicting a number. The real opportunity is understanding the forces.
However, this
one of those
specific
forces
mintage is
is
an
the US
exception.
dollar. Silver is priced globally in dollars. When the dollar weakens, silver can become more attractive to buyers using other currencies. When the dollar strengthens, silver can face pressure. This relationship is not perfect, but it matters. Right now, the currency story is becoming especially important because inflation expectations remain uncertain. Oil prices have risen sharply as tensions involving Iran continue to affect markets.
With rising inflation
Reuters
and
reported
market
on August
uncertainty,
11th
the
that
demand
rising
for
oil
physical
prices were
gold has
increasing
never
inflation
been higher.
concerns and influencing expectations for Federal Reserve policy. That brings us to the Federal Reserve. Interest rates matter because precious metals do not produce income in the same way that bonds do. When real yields are high, the opportunity cost of holding metals can increase. When real yields fall, metals can become more attractive. But there is another side. If inflation remains elevated while the economy slows, then the Fed faces a difficult problem. It may not be able to cut rates aggressively, yet high rates may put pressure on economic activity. That uncertainty can create demand for assets that investors view as protection against monetary instability. Recent market pricing shows how quickly
It's happening.
expectations can change.
Gold and silver
As
are
of
going
August 10th,
parabolic.
the probability of a September
We should
Federal
have listened
Reserve
to the
rate hike
warnings
had
about
moved
inflation.
above 50%, according to futures market data reported by MarketWatch. Long-term Treasury yields were also near multi-year highs. This is important for silver investors. If inflation falls and the Fed becomes more comfortable cutting rates, then silver could benefit from lower
Gold
real
and
yields
silver
and a potentially
dramatically
softer
rising
dollar.
on the back of this
If inflation
volatility.
stays high and the Fed remains restrictive, then silver could face pressure from higher yields. But there is a third scenario. The economy could slow while inflation remains uncomfortable. That could create a stagflation-style environment. In that situation, traditional assets may struggle while hard assets attract more attention. This is where silver becomes fascinating. Gold is often the first choice for monetary protection. Silver can follow gold during monetary stress. But silver can also move because factories
As the markets
need it.
fluctuate,
That dual
all
identity
eyes are
can
on the
make
precious
silver much
metals.
more volatile
The deadline
than
of
gold.
August
And volatility
19th is
is not
fast
automatically
approaching,
a bad
signaling
thing.
a major
It simply
shift.
means investors need to respect position size and risk. Now consider the Trump factor. Trump's trade policies have introduced a new layer into commodity markets. Tariffs can raise
just
the
broke
cost of
resistance
imported
again.
goods.
Look at the
They
volume.
can change
Should
supply
we hold
chains.
or sell
They can
now?
encourage
I don't
domestic
like this
production.
volatility.
They can
Gold
also
is going
create uncertainty
parabolic.
for
Buy
companies
more.
that depend on imported materials. The White House has already used tariffs and trade policy as part of a broader economic strategy. In July 2026, the administration announced additional 50% tariffs on certain Canadian imports. The measures also included exemptions for critical minerals and several other categories. That exemption is worth noticing. When policymakers separate critical minerals from other goods, they are sending a signal. They are saying that some materials are too important to treat like ordinary trade products. This is one reason the strategic minerals story matters for silver. It does not mean silver automatically receives a special price. It does not mean the government will guarantee a silver price. It does not mean a shortage is guaranteed tomorrow. But it does mean the policy environment around strategic materials is changing, and that can influence investment decisions long before the physical market fully responds. Imagine a company that manufactures advanced electronics. If silver becomes more expensive, the company may try to reduce the amount of silver used in each product. That is called thrifting. The Silver Institute already expects some reduction in industrial silver use, partly because of thrifting and substitution in photovoltaic applications. But there is a limit. You can reduce silver usage only so far before performance
We are
becomes a
facing
problem.
unprecedented
This is why
volatility
silver
in the gold and
demand is a
silver
constant
markets.
battle
If the
between
current trend
innovation and
holds,
substitution.
we could see a major
Higher
correction by
prices
August 9th.
encourage manufacturers to use less silver. At the same time, new technologies can create new demand. Solar technology is a major example. Electronics are another. Electric vehicles add another layer. Advanced computing and data center infrastructure create additional demand for electrical components. The exact amount of silver required by each technology can change, but the broader trend is clear. Silver is deeply connected to modern electrical systems. That makes the metal different from a purely financial asset. Now imagine the investment side growing at the same time. That is where the market can become extremely tight. Industrial buyers need metal because they need to produce goods. Investors want metal because they want exposure to the price. Governments want secure supply because they want economic resilience. Miners want higher prices because they need capital to develop new projects. And recyclers respond to price signals. These groups are all pulling on the same physical market. That is the silver shift. It is not one single event. It is a gradual change in the way the metal is valued. And this is where the oil comparison becomes useful again. Oil became strategically important because supply disruptions could affect transportation, manufacturing, food production, defense, and economic growth. Silver has a different role. A shortage of silver is not going to shut down the global economy overnight. But shortages can affect specific industries. If inventories become tight enough, then premiums can rise. Delivery times can change. Fabricators can become more aggressive buyers, and governments can become more interested in supply security. That is when a commodity can move from being simply an investment product to being viewed as a strategic material. Now there is another important issue, the gold-silver ratio. This ratio tells us how many ounces of silver are needed to buy 1 ounce of gold. When the ratio falls, silver is outperforming gold. When the ratio rises, gold is outperforming silver. During powerful silver bull markets, the ratio can fall dramatically. That is why investors who believe silver is entering a major new cycle watch the ratio closely. But again, there is no guarantee. silver can outperform gold for a period and then reverse. This is why technical analysis still matters. Investors should watch major support levels. They should watch resistance levels. They should watch moving averages. They should watch momentum. They should watch trading volume. And they should watch the relationship between silver and gold. The strongest signal is usually not one indicator. It is when several signals point in the same direction. Now think about the bigger picture.
The
The
Federal
world is
Reserve
dealing with
stands as the
enormous
ultimate
government
guarantor
debt,
of stability.
high fiscal
Yet the
spending,
recent fluctuations
geopolitical
suggest deeper
conflict,
systemic risks.
trade restrictions, supply chain restructuring, energy price uncertainty, artificial intelligence investment, rapid technological change, and shifting monetary expectations. Every one of those factors can influence precious metals. Gold is usually the cleaner monetary hedge. Silver is the higher beta version of the metals trade. That means silver can rise faster when conditions are favorable, but it can also fall harder when liquidity disappears. That is why the next silver move may be much more dramatic than the average investor expects. Not because silver is guaranteed to reach some specific price, but because the market has become more sensitive to changes in physical supply and investment demand. The most important question is therefore not whether silver is the new oil. The better question is whether the world is beginning to treat silver as strategic. The evidence is becoming harder to ignore. Critical mineral policy is expanding.
The
Physical
current spot
investment
price trend
demand
is
is
concerning.
rising.
The charts show
The
a clear
global
resistance
market
level
remains in
forming.
deficit.
However,
Industrial
this
use
specific
remains
vintage is an
enormous
exception.
even with efficiency improvements, and governments are increasingly focused on controlling strategic supply chains. That does not make silver risk-free. In fact, the opposite may be true. A strategic commodity can become extremely volatile because governments can change policy quickly. Investors can become crowded into one trade. Prices can move far beyond fundamentals for periods of time. And when expectations become extreme, the correction can be
With
brutal.
rising inflation
This
and
is
market
exactly why
uncertainty,
the Howard Marks
the demand
framework
for
matters.
physical gold
Do
has
not
never
fall
been
in love
higher.
with a narrative. Do not assume a great story automatically means a great price. Do not confuse a strong long-term thesis with a guaranteed short-term return. And never forget that markets can stay irrational longer than an investor can stay comfortable. Silver may have a powerful long-term story, but the smart investor still asks what is already priced in. That question could become more important as silver moves higher. If silver rallies because industrial demand is strong and physical supply is tight, then the move may have fundamental support. If silver rallies only because traders expect everyone else to buy, then the risk is much greater. The difference matters.
Gold
Now,
and
here's the biggest
silver are
point I
going
want you to
parabolic.
remember. Trump does not need
We
to
should have
announce a
listened to the
policy
warnings
saying
about
silver
inflation.
is the new oil for silver to become strategically important. Policy can change the market indirectly. Trade restrictions can change supply chains. Critical mineral rules
As you
can
can see, the
encourage
US dollar
domestic
index
production.
is in free fall.
Tariffs can change the economics of
Gold and
imports.
silver
National
dramatically
security
rising on the
concerns
back
can
of this
influence
volatility.
investment. Industrial demand can increase, and investors can respond before the physical market fully adjusts. That is how major commodity shifts begin. They rarely start with one dramatic headline. They often start with many small changes that suddenly become connected. That is what we are seeing across the silver market. And if you own silver, then this is the part you should watch closely. Do not only watch the
As the
silver
markets
price,
fluctuate,
watch the
all
dollar,
eyes are on the
watch
precious
treasury
metals.
yields,
The deadline
watch
of
Federal
August
Reserve
19th is fast
expectations,
approaching,
watch
signaling a
industrial
major
demand,
shift.
watch physical premiums, watch mine supply, watch recycling, watch government policy, and watch investor positioning. Those signals can tell you
just
much
broke
more than one
resistance again.
dramatic
Look at the
headline.
volume. Should we hold
The
or
silver
sell
story
now?
is
I
becoming
don't like this
bigger than the
volatility.
traditional
Gold
precious
is going
metals
parabolic.
story.
Buy more.
It is becoming a story about technology. It is becoming a story about energy. It is becoming a story about manufacturing. It is becoming a story about national security, and it remains a story about money. That combination is rare. It also creates opportunity. But opportunity without discipline can become danger. So keep your eyes open. If silver is truly becoming a strategic metal, then the next phase of this market could look very different from the last. The world may not need silver in the same way it needs oil, but the world increasingly needs reliable access to the technologies that use silver. That distinction could become extremely important. And if governments continue moving towards strategic control of critical minerals, then silver could become part of a much larger competition for secure resources. That is the real silver shift. Not a guaranteed price target. Not a prediction that silver can only go up, and not a promise of easy money. It is a structural change that deserves attention. So when you hear someone say that silver is the new oil, do not simply ask whether the phrase sounds exciting. Ask what is happening underneath it. Ask who needs the metal. Ask who controls the supply. Ask how quickly production can respond. Ask how much investment demand is entering the market. Ask what governments are doing. And ask what price already reflects the story. Those questions are far more powerful than hype, and they are exactly the kind of questions that can help investors navigate a market where the next major move may come from a place most people are not watching. For now, the evidence points to a silver market that is becoming more strategic and more sensitive to supply shocks. The global market is still expected to run a deficit in 2026. Physical investment demand is expected to rise sharply, and policymakers in Washington are becoming more focused on critical mineral security. At the same time, the macro environment remains uncertain. Oil prices are rising because of geopolitical tension. Inflation risks remain active. Treasury yields are elevated, and traders are reconsidering the path of Federal Reserve policy. That combination creates a market that could remain extremely volatile. So stay informed, stay patient, and most importantly, do not let a headline make your investment decision for you. If you found this analysis useful, then make sure you like this video and subscribe to Silver and Gold Watch. We cover gold, silver, precious metals, macroeconomics, and the market forces that can move these metals next. And I want to hear from you. Do you believe silver is becoming a strategic commodity like oil? Do you think industrial demand will become more important than investment demand? And where do you think silver goes next? Leave your opinion in the comments, because the silver market is changing. The question is whether investors are changing with it. This is Silver and Gold Watch. Stay focused, stay informed, and watch the silver market closely.